The stock market is finally seeing a little selling after its large rally to start the year. So in today's video, I want to discuss 5 stocks that I think are offering value in this market, despite the S&P 500 still being near all-time highs. Before we get into this video though, I want to let you all know that my book, The Fundamentals of Investing, is officially available on Amazon. Thanks to so many of you ordering the book already, it has become the #1 bestseller in the stock market category on Amazon, and it has received some pretty incredible reviews so far. So if you're interested in learning more about fundamental investing and learning how to find stocks that can compound your wealth over the long term, then consider checking out my book. I will put a link at the top of the description to this video, and with that being said, let's now hop into the 5 stocks that I think are still offering value in the market. And the first one is Amazon. Amazon had a very good fourth quarter 2023 earnings report, and the stock is back up near all-time highs. However, this is one of the Magnificent Seven that is not selling for all-time highs right now. Like Apple, Microsoft, and Google are right back to all-time highs or near all-time highs, but Amazon is not quite. Now, if we go and take a quick look at Amazon's financials right here, we can see that in the trailing 12 months, its revenue is sitting at an all-time high. And if we take a look at the percent change, we can see that Amazon's revenue growth has been accelerating over the past about 8 quarters now. So again, Amazon's revenue is at an all-time high, and its growth rates are starting to pick up. Now, if we take a look at Amazon's operating cash flow, we can see that it is absolutely exploding, and it is sitting at an all-time high now of about $85 billion. Now, this was my entire investment thesis on Amazon when I was buying it at the end of 2022 when the stock was in that massive correction. As I have said on my channel before, Amazon's stock tends to follow its operating cash flows. So while its operating cash flows were declining, the stock was going down. However, I strongly believed that Amazon was going to increase its profitability and increase its profit margins and get its operating cash flow back up. And this is exactly what has happened. And again, we can see that Amazon's operating cash flow is now sitting at an all-time high by far and going up rapidly. However, again, Amazon stock is not selling for an all-time high, which is partly why I believe that this stock is still offering value. Now, if we go and take a look at Amazon's historical price to operating cash flow, which is the metric that the market seems to track the most accurately, we can see that Amazon is selling for a price to operating cash flow of about 20.9 today. Its historical average over the past 15 years has been about 27.6. So relative to its historical average, it is selling about 30% below its average. Now, what I have pointed out on my channel before is that historically, every time Amazon's price to operating cash flow gets down to about 20, the stock seems to bottom. For example, here in 2015, the stock bottomed at a 20 price to operating cash flow, then again in 2016, then again in 2017, and even in the stock market crash of 2020, Amazon's price to operating cash flow was about 23. So Amazon's price to operating cash flow today is selling near the business's historical lows, and it's actually lower than when the stock was selling off in the stock market crash of 2020. And personally, I do believe that Amazon's operating cash flows will continue to grow over the long term, and this business does have a lot of tailwinds behind it right now. For example, in Amazon's most recent earnings report, we can see that its third-party seller services business is now doing about $43.5 billion in revenue per quarter, and it's growing at 20% annually or year over year. The advertising services is now also doing roughly $15 billion per quarter in revenue and growing at 27% year over year. Subscription services are doing $10.5 billion in revenue per quarter and growing at 14% year over year. And AWS is doing $24 billion in revenue and growing at 13% year over year. These 4 businesses right here are absolutely massive, and they're all growing at double-digit growth rates. So I do think that Amazon's business, even though it's large, it is still growing quite quickly, and it does have a lot of tailwinds behind it, which again should push its operating cash flow to continue growing over the long term. So now let's do a quick discounted cash flow calculation on Amazon to show you my thinking here. In this, we are tracking Amazon's operating cash flow over the next 5 years, and I'm going to say that Amazon's operating cash flow is going to compound at 8% annually over the next 5 years. The company is going to see no dilution and trade for a price to operating cash flow of 25. And when we enter in these metrics, we can see that the fair value of Amazon is about $186 per share, and the business should deliver a compounded annual growth rate of 12.3% based on these metrics. Now, personally, I do believe that Amazon can compound its operating cash flows at 8% over the next 5 years, and a 25 price to operating cash flow is more in line with how Amazon has traded historically, and it's actually still below its historical averages. So I don't think that these metrics in this calculation are insane by any means, and I actually do think that Amazon can hit these numbers right here. And this is partly why I believe that Amazon is still offering value in the markets today. But now let's move on to the second stock that I want to talk about, and this one is Brookfield Corporation, or BN. Brookfield is also the largest position in my portfolio, and it reported earnings a few days ago. I did make a video on those earnings, so if you would like to see a full deep dive on how this business is performing right now, then you can go and check out that video. The stock has been performing well over the past few months, but personally, I do still think that it is cheap. To put this in perspective, my first Brookfield buy was at $52 Canadian in 2022, and then the stock fell quite hard, and it stayed down for about a year. But during this time, I continued to add to my position as I thought the stock was only getting cheaper and offering better returns as it fell. Now the stock is back up to about where I was first buying it, but the business is much larger now, so I actually do still think that Brookfield is cheap today. So let me point out some of the highlights from Brookfield's earnings report. Right here we can see that its distributable earnings, which is the business's metric for its free cash flow, did grow year over year by about 12%. And these red boxes right here that I added are the company's core distributable earnings from its actual operations. And you can see that the business's operational distributable earnings is growing year over year, which is a great thing to see. Now this next screenshot comes from Brookfield's Investor Day from 2023, and it's its 5-year projections out to 2028. So we can see that distributable earnings before realizations are projected to be $6.34 by 2028 and compound at a 22% annual growth rate. So basically, Brookfield is projecting to grow its free cash flows by 22% annually over the next 5 years. Now, what's interesting is Brookfield did about $5 billion in distributable earnings for 2023. The business is also worth about $67 billion on the stock market today. So if we go $67 billion of market cap divided by $5 billion in annual distributable earnings, and again, distributable earnings is basically free cash flow for Brookfield. This means that the business is selling for about 13.4 times free cash flow, while also projecting to grow its free cash flows by 22% annually over the next 5 years. Now, in the market, I don't see this kind of relationship very often, where a business is trading for a price to free cash flow of roughly 13, while also projecting 22% annual free cash flow growth over the next 5 years. So this is why Brookfield is the largest position in my portfolio, and why I do believe that it is still offering value in the markets. Now this next screenshot is from Brookfield's Q4 letter to shareholders, and right here it says, "We believe the intrinsic value of a BN share today is significantly above the current share price. This offers our shareholders a large margin of safety for investment at this point in time." So Brookfield has been telling their shareholders that they do believe the stock is undervalued relative to what the actual business behind the stock is worth. And Brookfield has been saying this for about a year now, and I have seen some investors say that this is actually a red flag. However, if you go back throughout history, Brookfield has told their investors when they also believe that the stock is expensive relative to the value of the business. Brookfield has also said that price and value are not the same things. And what they try to do with their shareholders is tell them when they believe the stock is overvalued relative to the business and when the stock is undervalued relative to the business. Bruce Flatt, who is the CEO of Brookfield, has been quite consistent by sharing his honest thoughts on when the stock is over or undervalued. And right now, he does believe the stock is undervalued. Additionally, Bruce Flatt wrote this in the most recent letter to shareholders as well. "We are aligned with the largest and fastest growing companies in the world. Demand for cloud computing and digitalization and the adoption of AI-enabled tools is incentivizing these companies to continue investing heavily in their capabilities and capacity. We believe that most investors have yet to grasp that there has been an equivalent surge in the need for data centers and for securing an energy source required to power them. We have significantly expanded our data center operations. Following the Data4 and Compass acquisitions, we now own and operate one of the largest global hyperscale data center platforms. Perhaps most uniquely, we have the ability to leverage Brookfield's ecosystem to provide turnkey solutions that include renewable power connectivity." So what Brookfield is saying here is that this huge AI wave is also benefiting Brookfield's business, because Brookfield is one of the largest owners of data centers worldwide. Additionally, Brookfield has an entire Brookfield Renewable segment of the business that is entirely focused on generating renewable power. So what Brookfield can do is power its data centers with renewable energy by leveraging the entire business. Now, why this is attractive to these massive companies like Microsoft, Google, and Amazon is because they do have net zero targets that they want to achieve. So these businesses are going to need a lot more data centers and a lot more capacity, and they are also going to want renewable power powering their data centers to help them achieve their net zero emissions. And Brookfield can fill in this slot. And this is partly why Brookfield's business has been growing as well. So Brookfield is not missing out on the AI wave, and they're actually one of my AI plays because they are one of the businesses that is powering the AI revolution that is currently going on. It's just that people aren't really focused on the businesses that are powering this AI wave through data centers right now. At least that kind of seems to be the story. So now let's do a quick discounted cash flow calculation on Brookfield. And we are going to project out its free cash flow over the next 5 years. Now, the business did say that it is projecting to grow its free cash flows by 22% annually, but let's just say 20% annually in this calculation. Let's also say that its price ratio expands slightly to a price to free cash flow of 15, which I do still personally think is cheap, but let's just use this price ratio for this example. Now, if Brookfield can compound its free cash flow at 20% annually and trade for a 15 price to free cash flow, then the fair value of the stock today is about $70.66, which is 81% above where the stock is currently trading. If these projections are realized, then this could offer a compounded annual growth rate to the stock of about 24% over the next 5 years. Now, what I also like to do is a reverse discounted cash flow calculation, which shows you what the market is currently pricing in. So what the market is currently pricing in for Brookfield is annual free cash flow growth of about 6.6%, and again, that 15 price to free cash flow. And here we can see that with this growth rate, the business is selling for about fair value today and could offer compounded annual growth of about 10% to its stock price. However, I do believe that Brookfield is going to grow its free cash flows well above 6.6% annually over the next 5 years. So basically, even if the business does not hit its 22% free cash flow growth projections and does something around 15%, then this business, in my opinion, is still selling for a margin of safety today and could offer outsized returns over the next 5 years to its shareholders. This is why Brookfield is the largest position in my portfolio right now, and why I believe that it is still undervalued in the market today, and why I am happy to continue building out my position for the long term, despite the market being at all-time highs and Brookfield producing about 40% returns from its lows now. All right, now let's move on to the third stock that I want to talk about in this video, which is Alibaba, which also reported its earnings last week. And to summarize Alibaba's earnings, in my opinion, they were acceptable, but they were not exceptional. And overall, I do still think that this business is very, very cheap based on its fundamentals and simply looking at its metrics. So let's quickly go over some of the highlights from Alibaba's most recent earnings report. So right here, we can see that all of Alibaba's business segments are growing revenues year over year. And we can see that Alibaba's international digital commerce group grew by 44% year over year, and its smart logistics network grew by 24% year over year. The overall business's revenue did grow by 6% year over year, so the business is still growing its top line, which I do like to see. However, Alibaba's operating income declined by 36% year over year, and its net income declined by 77% year over year. So this is why I think the stock is still low and why the market sold off the stock after earnings. Despite the revenue growing, its overall net income did decline. Now, if we move on to Alibaba's cash flow statement, we can also see that its operating cash flow did decline by about 25% year over year, to about $9.1 billion in the quarter. Its free cash flow also declined by about 30% year over year to about $8 billion in free cash flow for the quarter. However, this company is still generating billions of dollars in free cash flow and is very much so a profitable business. If we also take a look at Alibaba's balance sheet, they have a cash balance of $92 billion now and a net cash position of about $69 billion. So even factoring in all of the company's debt, again, they do still have a net cash position of $69 billion, which means that this business is absolutely cash rich. Now, if we take a look at the adjusted EBITDA of Alibaba's different business segments, we can see that 3 of them are currently profitable, and Alibaba's international digital segment is actually unprofitable right now. Personally, I think that this is because Alibaba is investing a lot of money into its international business, and that is causing the business to be unprofitable right now. But these investments are working because this business segment did grow by 44% year over year. Then we can see that these other business segments are actually losing Alibaba money. Now, what's interesting is Alibaba is wanting to restructure the business a little bit and kind of is looking like a little bit of a turnaround play to me personally. What the business wants to do is sell off all of its non-performing assets that are not core to the business. And Alibaba wants to do this so that it can refocus on its core businesses, which are profitable and growing quickly. What's also interesting is the co-founders of Alibaba, Jack Ma and Joe Tsai, have acquired shares worth hundreds of millions of dollars in the open market over the past couple of months. This article says an entity linked to Tsai's family office, Bluepool, acquired nearly 2 million Alibaba depository shares worth $152 million in the fourth quarter. Jack Ma acquired $50 million worth of Alibaba's Hong Kong stock during the same period. So the co-founders of Alibaba are acquiring hundreds of millions of dollars worth of shares of Alibaba in the open market, which clearly suggests that they think that the stock is cheap and offering value. Now, to also put this in perspective, Alibaba's stock is trading for a price to free cash flow of 6 now, which is a free cash flow yield of about 16%. So if Alibaba wanted to pay out all of its free cash flow as a dividend to shareholders, then it could pay out a 16% dividend based on its current market cap. So this to me suggests that the stock is quite undervalued right now. And we also have to think that Alibaba has $69 billion of cash on its balance sheet. So Alibaba's enterprise value is actually only around $110 billion right now. And if you want to do an enterprise value to free cash flow calculation, then the stock is selling for an enterprise value to free cash flow around 4, which is absolutely ridiculously cheap. That is almost a 25% free cash flow yield on the business's market cap today. So in my opinion, I think that Alibaba is ridiculously cheap in the market right now. And I think that this is because a lot of investors do not want to own Chinese stocks. And I understand the fear around Chinese stocks, okay? I get it. But in my opinion, some of these Chinese stocks like Alibaba are at the price now where this risk is being offset and more. Like, unless Alibaba's business goes bankrupt, which I do not think is going to happen, then I think that the stock price today could offer significant returns over the next 5 years as the market becomes more bullish on these businesses and as these businesses' fundamentals continue to grow. For example, if we do a quick discounted cash flow calculation of Alibaba, and we said that its operating cash flow is going to grow by 4% annually over the next 5 years, and the business is going to buy back 3% of its shares over the next 5 years annually, which is what the company said it wants to do in its most recent earnings release, and it will trade for a price to operating cash flow of only 10, which is well below the company's historical averages, then the fair value of the business is $105 per share, or about 45% above where the stock is currently trading. The stock could also offer a compounded annual growth rate of 18.6% over the next 5 years. And this is with only 4% operating cash flow growth and a 10 price to operating cash flow, which in my opinion is still a very low price for Alibaba's business. So when I take a look at these numbers right here, it does suggest that Alibaba's stock is selling for a margin of safety and is quite cheap in the stock market right now. So again, in my opinion, I do believe that Alibaba's stock is quite cheap in the market today and actually offering investors a margin of safety. All right, now let's move on to the fourth stock that I want to talk about in this video, which is Brookfield Asset Management, and is actually a different ticker than BN, which we discussed earlier. Brookfield Asset Management, in my opinion, is the best dividend growth stock in the entire market, and let me explain why. Brookfield Asset Management announced a 19% dividend increase to $1.52 per share in its most recent earnings report. This is now a 3.88% dividend yield on this business. Now, what's interesting is Brookfield Asset Management is projecting to grow this dividend by 15 to 20% annually over the next 5 years. In my experience in the stock market, it is very rare to see a business with such a high dividend yield and also so much dividend growth. Typically, when I see a business with around a 4% dividend yield, the dividend is growing from anywhere between 5 to 8% annually. It's not usual to find a 4% dividend that's also growing at 15 to 20% annually. For example, if we head over to Fortis, this business has a 4.5% dividend yield, and over the last 5 years, it has grown at about 5.6% annually. If we also head over to Royal Bank of Canada, this one has a 4.3% dividend and has grown by 6.6% annually over the past 5 years. And these dividends are not much higher than Brookfield Asset Management. So Brookfield Asset Management is like a growth stock that also pays out a significant dividend. And again, I have not really seen this before in the market, and it's why it's my number one dividend income growth stock. Now, if Brookfield can achieve a 15% annual dividend growth rate over the next 5 years, then it means that the dividend yield on cost of shares purchased today should be roughly 8%. That is a very nice dividend yield on cost within a short period of time. Brookfield Asset Management also recently put out their fourth quarter 2023 investor presentation, and this was roughly a few days ago. I just found this information, so it's brand new to the channel. And this slide says investors worldwide are turning to alternative assets, and Brookfield Asset Management is an alternative asset manager. Then it says, as institutional investors increase their allocations to alternatives, the overall industry saw rapid expansion and is estimated to grow to $25 trillion by 2028. So institutional investors are moving more and more of their funds into alternative asset managers because they have been generating very significant returns that actually outpace the S&P 500. On the right-hand side of this slide, we can see that alternatives assets under management has grown by 6x since 2010. That is a very rapid growth rate over just the past decade. And again, assets under management is projected to grow to $24.5 trillion by 2028, which is a net of another 50% growth to this overall industry. Then Brookfield says, Brookfield has strong portfolio and earnings growth. With almost $100 billion of capital inflows over the past year, in addition to our acquisition of AEL expecting to close in early 2024, we are on track to hit our target of $1 trillion in fee-bearing capital within 5 years. And then we can see that Brookfield's assets under management is growing by 23% annually, which is a very strong growth rate. The company is also expecting its fee-related earnings, which is basically just the company's earnings, to grow to $4.8 billion by 2028, which is a 19% compounded annual growth rate. So not only is the dividend projected to grow quickly in the future, but the business's earnings are projected to grow by nearly 20% annually as well. Now, what's also interesting about Brookfield is the capital that they invest for their clients, they get a portion of the earnings from. So if they produce a significant amount of earnings on their invested capital, then Brookfield actually gets a portion of those profits for themselves. This is called carried interest, and Brookfield says this here, with increased realized carry potential in the future. As our carry eligible capital continues to grow, carried interest will become a significant contributor in the future. So Brookfield Asset Management is projecting their carry eligible capital, which is essentially the capital that they can earn earnings from or profits from. It is projected to grow by 43% annually out to 2028. They're also expecting to realize $2 billion of profits in the year of 2029 alone. Now, what this means is that in addition to the roughly $5 billion of earnings that Brookfield Asset Management is projected to generate in 2028, they will also be doing about $2 billion of realized gains or profits on their investments by that year, which is a net of $7 billion in potential earnings for shareholders by 2028 and 2029, which is a pretty significant amount. They also expect these realized profits to grow to $7 billion just for the year of 2023. So the realized profits is another area of Brookfield Asset Management's business that is really going to start to kick in and create shareholder value at the end of this decade. So for long-term investors such as myself who have a long runway for future growth with this business, then this stock should start paying a significant amount of dividends at the end of this decade and far into the future. Because as we can see here, one of Brookfield's main goals is to pay out 90% of the company's entire earnings as a dividend to its shareholders. So if Brookfield does $7 billion in total earnings in 2029, then 90% of that, which is $6.3 billion, will be paid out to its shareholders as a dividend. Now, I already did all of the math on another screen here, so I'll just summarize it all for you. What this means is that including Brookfield's realized gains on its investments by 2029, the business should have a dividend yield on cost of around 12% based on its share price today. So when we factor in the business's overall growth to its fee-related earnings and then add in those realized profits that they're projecting over the next about 5 to 6 years now, then the dividend yield on cost today goes up dramatically. And that again is why I say that this is one of the best dividend growth stocks that I have ever seen in the market. Now, if we head back over to Brookfield Asset Management on Stock Unlock, we can see that the business has a market cap of $15.81 billion today. The business also did $581 million in earnings for the year of 2023, and it is expecting roughly 20% earnings growth in 2024. This means that the business should be doing roughly $700 million in earnings for 2024. Now, if we take that $15.81 billion market cap and divide this by $700 million in earnings for 2024, this means that the business is selling for a forward price to earnings ratio of about 22.6. In my opinion, this is not a high price to earnings ratio to pay for a business that is projecting to grow its earnings by 15 to 20% annually over the next 5 years. and should actually produce a significant amount more earnings at the end of this decade. So I actually believe that Brookfield Asset Management is selling for fair value, if not below fair value today. And what we can do is head over to our discounted cash flow calculator once again, and this time use Brookfield Asset Management. So in this calculation, we are projecting out Brookfield Asset Management's earnings over the next 5 years, and we're going to say that the earnings are going to grow at 19% annually, which is the company's internal projections. We're also going to say no dilution, which is what the company is doing right now, and that it is going to trade for a price to earnings ratio of 24, which is the company's average since it has been spun off from Brookfield's corporation, the parent company. So basically, we're saying the company is going to grow its earnings by 19% annually and trade for a 24 price to earnings ratio. And if the company can do this and achieve its own projections, then the fair value for the stock is 27% above where the stock is currently trading, or $50 a share. The compounded annual growth rate to the shares should also be 15.5%, and this is not including the company's dividend. So if we include the dividend of about 4%, then this is a compounded annual growth rate to the stock, including dividends, of about 19%. That is a very strong return. So in my opinion, if Brookfield Asset Management can hit its own projections, then I do think that the stock is undervalued today and selling below fair value, which is one of the reasons why I think that it is still a stock offering value in this market that we're in February of 2024. Now, the last stock that we are going to talk about is a new one to the channel that I have never discussed before. I actually discussed this in my Discord with my Patreon group about a month ago when the stock was $20 a share. Unfortunately, I never ended up buying GCT, which is GigaCloud Technology, but I want to go over the reasons why I found this stock so interesting based on its fundamentals. Again, I want to be crystal clear. I have never purchased the stock and I am not planning on buying the stock right now. I just want to show you guys how I found it and why I thought that it looked so interesting. So this company has a market cap of $1.27 billion. It also has a stock unlock insight score of 4.34, which is pretty dang high. Also, since October of 2023, the stock is now up roughly 300%. So the stock has been absolutely skyrocketing for about 5 to 6 months now. But despite the stock price rising so much, it's still selling for a price to free cash flow of only 11.7, which is a free cash flow yield of 8.5. So yes, the stock is hitting brand new all-time highs even today when the market is selling off. But when I take a look at its price ratios and its free cash flow, it actually still doesn't look that expensive. Now, if we head over to the company's financials, we can see that its revenue has also been growing quite well, and it is sitting at an all-time high. If we also head over to the company's operating cash flows, we can clearly see that it was roughly unprofitable here in the first quarter of 2022, but since then, the company's operating cash flows have been growing massively, and it has now produced about $109 million in trailing 12 months operating cash flow. Now, if we continue on down the cash flow statement, we can see that the stock-based compensation was only $2 million in the trailing 12 months, which is less than 2% of operating cash flow and is not a lot of stock-based compensation. This to me is a good thing, and I like to see that. We can also see that its capital expenditures were only $900,000, which basically means that all of this operating cash flow became true free cash flow for the business, which we can see right here with producing $108 million in trailing 12 months free cash flow. We can also see that the free cash flow is growing rapidly. And remember, this is a $1.2 billion business. So it's trading for 12 times free cash flow roughly. And take a look at that free cash flow and revenue growth. That to me is very attractive. Now, additionally, if we head over to the balance sheet, we can see that it has $214 million in cash and current liabilities of $140 million and total liabilities of roughly $275 million. So with its existing cash position, it could almost wipe out all of its liabilities and become completely debt-free. And then on top of that, it's generating $100 million in cash flow annually. So the business is very financially sound, it's growing very rapidly, its free cash flow is growing quite quickly, and it's still trading for a price to free cash flow of only 12, even though the stock is trading for all-time highs right now. And again, I found this stock about a month ago, and how I found it was actually using Stock Unlock's screener right here. I was scanning for US mid-cap stocks, and GCT was number 4 on the results. And the reason why I like Stock Unlock's screener is because it ranks the results from my filter, and it shows me the most fundamentally sound stocks at the top of my search, so I can see which stocks actually have the strongest balance sheets, the most growth, the best management scores, etc., at the top of all of my filter selections. And again, GCT was number 4 right there. But overall, I do think that GCT's fundamentals do look very strong when we're looking at the numbers. The reason that I did not end up purchasing the stock is because I don't fully understand what it does, And as you guys know, a business has got to have a moat that I can easily identify for me to purchase it. And since I could not identify GCT's moat, it was not a stock that I could buy. It's a stock that is on my watch list and I still need to research more, but it's just been absolutely skyrocketing. And I did want to throw this one on your radar to maybe research it on your own or add it to your own watch list. But again, I don't really understand this business. I don't know its moat, so that is why I am not buying it. I'm just bringing it to the channel's attention and showing you guys why I thought that the stock was looking interesting initially. But that is going to wrap up the video for today, everyone. And if you did enjoy this video, then please remember to leave a like on it because it really does help my channel grow. Additionally, if you want to stick around and see more stock market related content like this, then please consider subscribing to my channel as well. And lastly, if you are interested in checking out my book or picking up a copy of The Fundamentals of Investing, then there will be a link at the top of the description. And I also have a video explaining the content within the book if you want to go and see what I actually discuss and cover in the book. And then you can also see if the book is right for you. Again, it is now a #1 Amazon bestseller, and I am starting to get some really solid reviews on the book, which is making me super happy. So go and check out The Fundamentals of Investing on Amazon if you want to improve your investing and support my work. But with that being said, thank you all so much for watching. I truly do appreciate it, and I really hope to see you all again in my next video.